Do you think this is the time where it could actually happen? We could start to see some central banks starting to add it onto their book?
I actually don't think they're mentally prepared for that sort of leap. They understand gold. They've been trained in gold. They read history books about gold. The most likely outcome would be just do something like what China is doing, right? 20% of the hash rate comes from China. You can't privately mine Bitcoin in China. It's all the governments and state-owned entities doing it. So if you have a surplus of energy, then you save it in Bitcoin. Some countries in the UAE are doing that, oil exporting nations, all that kind of thing. So I think it's more likely that you say, okay, well, I'm producing excess energy. I'm going to store that in Bitcoin versus I'm going to, buy Bitcoin with my dollar earnings. Now, of course, there's smaller countries like El Salvador will do this. But I'm talking about like major economic powers, central banks say, I'm going to buy some Bitcoin and hold it.
Imagine a world where the institutions that have governed the global financial system for centuries, central banks, decide to trade in their golden reliquaries for the digital gold of the future. Bitcoin. Sounds like a fantasy, right? To most financial traditionalists, this idea is unthinkable. These institutions have built entire monetary systems around the unwavering faith in gold's stability. Yet, here we are, at the precipice of a radical transformation. Arthur Hayes, the unapologetic contrarian, isn't just offering a wild prediction. He's laying out the undeniable reality that Bitcoin's ascension could very well follow an unexpected path. Central bankers, entrenched in their gold-worshipping worldview, may not be ready to embrace Bitcoin directly. But what if the disruption happens not by choice, but by necessity? What if the very energy-rich nations that have long controlled global power, like China and the oil-producing giants, quietly begin converting their excess energy into Bitcoin through state-run mining operations? It won't be the grand crypto revolution we once envisioned, but it's a backdoor so powerful that Bitcoin could wind up as the reserve asset these institutions never planned for. Bitcoin's survival isn't some speculative fantasy. It's the quietly unfolding story of how the most unexpected asset will prove everyone wrong. When the next crisis hits, Bitcoin won't just survive. It will become the very thing that shocks the world into a new era of financial thinking. And while the traditionalists look back with regret, Bitcoin will continue its relentless rise, no longer as an outsider, but as the cornerstone of a new global reserve system. We will now bring you more clips from Arthur Hayes' interview. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
At the end of the day, yeah, they're going to print money. Bitcoin benefits. Now, the reciprocal of the current account deficit in the U.S. is a financial account surplus. And so all these dollars that got earned, the trillions of dollars that got earned selling stuff to America, got recycled into treasury bonds and stocks and, Mag 7, all the big US tech stocks. So mathematically, if Trump is serious about reducing the current account to zero, then foreigners have to sell stocks, period. It's just math. And then the question is, okay, well, can the US government survive financially if there's a big decline in capital gains taxes because the market's not going up? I don't think so. Therefore, we get a printing money function and Bitcoin benefits and finally decouples from tech because of the structural flows and what needs to happen from an affordability standpoint for the US government. So obviously, in the first few days after Liberation Day, stocks crashed, Bitcoin crashed. Okay, stocks just high beta NASDAQ. Fits the narrative. Then the yield started ripping as basis trading hedge funds were getting margin called, and people were afraid that there was being an unwind of all these positions and front running that trade. And the market stress started to increase. Move index went to 172 intraday, and Bitcoin started to rally. But then, because Trump and the team pivoted so quickly, then we got back to business as usual, and everything just goes up together. It's just a question of how much. And so, if further to today's press conference, if it's no longer I'm going to file Powell, it's no longer China's a big bad boogeyman, we're going to find a deal, then everything goes up. Bitcoin goes up more, but everything goes up. And so we don't really get a test of this. Is Bitcoin just high beta NASDAQ in the short term? Now, in the long term, I think that US tech exceptionalism as a narrative is dead. There are cheaper ways to do AI. You don't need to spend all this money. There's obviously DeepSeek and some other really cool LLMs coming out of China. It's questionable whether all this CapEx is being used. We're starting to hear reports from different channel checks on Amazon and Microsoft and them canceling leases on some of these data centers and whatnot. So again, big US tech spent a bunch of CapEx, just like they did in 2001. And we know what happened to Cisco. We've done 90-something freaking percent. Not to say that Google's going out of business, but I don't see structurally how these companies are going to be the leaders of the next rally. So it might not be that there's some sort of dislocation due to a divorce of the US and China and sort of trade. It's just the leaders of the last cycle become the laggards of the current cycle, and that being US tech. And Bitcoin continues to outperform because global liquidity continues to rise. We all were very well trained from 2008 to 2019 that the Fed does QE. It prints money every week to buy bonds. Stock market goes up, right? Just that was the game. We got conditioned. Where's the QE? Stock market goes up. Bitcoin goes up. Everything goes up, right? And so post 2020, after the little bit of inflation that the world experienced and every central bank raised rates, the community was like, okay, well, we know QE equals number go up. So where's the QE? And from 2022 until the current moment, Powell really, they cut a few times, but we haven't seen, and quantitative tightening was reduced a bit, but we haven't seen a 2008 to 2019 style quantitative easing program from the Fed. And that's left a lot of people saying, oh no, the Fed's being really, really tight. Therefore, I can't buy risk assets. So I'm going to sit on the sidelines and I don't know what you do. Because you're not in Bitcoin, you're not in NASDAQ, you're not in these things. Now, obviously that was the wrong trade because people forgot about the other side of the equation of what can the Treasury do unilaterally without the Fed. And so we've learned, Yellen, bad girl Yellen, or some staffer at the Treasury Department said, oh, there's $2.5 trillion sitting in this reverse repo program that doesn't really circulate within the economy. How do we get that money to come out of the reverse repo and into these bonds that we need to sell because we have a large deficit? I know we're going to increase the amount of Treasury bills. That is a Treasury debt security with less than 1 year maturity. And if the yield is a few basis points higher than the reverse repo, then the money market fund is going to pull the money out of the reverse repo and put it in the Treasury bill. The Treasury bill gets relevered throughout the system, and therefore liquidity goes up, stock market goes up, right? Now, Powell's over here doing his I'm a Paul Volcker, impersonation. I'm going to go and keep these monetary conditions tight. I really care about fighting inflation. On the other hand, Yellen just printed $2.5 trillion, but not really printed. It's not technically quantitative easing. And so people get caught up on this, oh, it's not QE, so the market's not going to go up. Yeah, but it still released $2.5 trillion into the market. So that was a September 2022 until sort of early 2025 situation. And that was a monster rally. And Bitcoin went up 6x in that period of time. So focusing on what Powell is doing was correct in the last cycle, but now it's a Treasury show. The Treasury runs the show. They dictate policy. So what do we get out of the news secretary Bessent's mouth recently? He sat down with a Bloomberg interviewer. I think it was on the April 11th or 12th in the heat of the moment and said, and the interviewer asked him, well, Powell's keeping tight monetary policy. What do you guys have any tools at the Treasury to help market conditions? And he said, I've got plenty of tools, specifically Treasury buybacks. And so again, it was increased bills versus bonds under Yellen, stealth quantitative easing. Bessent is going with Treasury buybacks, another form of stealth quantitative easing. Both of these programs require no input from the Fed, no input from Congress. They can implement them as and when they please. And so I believe that was a seminal moment in sort of this risk-off situation. And to me, that this feels like November of 2022 in that there's lots of reasons to hate the market and Bitcoin at that period of time. But if the Treasury is going to print $2.5 trillion, shit's going up. If Scott Bessent is going to do Treasury buybacks till the cows come home, shit's going up. And it has gone up since he made that announcement. They haven't started increasing the pace yet, but they will do because they can do it without input from the Fed. And so that's kind of where we're at. Eventually, the Fed will come around. They've already indicated that quantitative tightening is tapering. They might do some sort of like balanced runoff for mortgage-backed securities, the maturing mortgage-backed securities. That money is in purchasing fresh new treasuries. So there's lots of things that you can do that aren't quantitative easing, because that's a bad word. The plebs know what quantitative easing is. They know that means inflation.
Yeah.
You can't do that anymore. You got to be more creative. So I think
Yeah.
we have to be flexible in our mental models of what quantitative easing means, what money printing means. Look at the second order and third order effects of, okay, well, if they do this, how do the other market participants react? Do they buy more bonds? Do they move money from a sterilized pool on some central bank balance sheet into the general market, which can be releveraged through the banking system? So we have to be a little bit more, I guess, indirect in our thinking of how the quantity of money changes as treasury officials all across the world sort of take control from the central banks. Because the central banker says, I want to be independent. I care about the value of the fiat currency, blah, 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 right? And that's what they believe. But the treasury official says, this government's broke. The politicians want to spend the money. I work for the politicians. Therefore, I will make sure the government can fund itself at an affordable level.
When the Treasury's money printer roars, Bitcoin soars. The US can't kick its deficit addiction, so it's pumping stealth liquidity via T-bill tricks and buybacks, bypassing the Fed. Stocks may stall as foreign buyers flee, but Bitcoin? It's the escape hatch. Forget QE. This is financial engineering on overdrive, and hard assets win. With tech giants peaking and yields rigged, the next crisis won't crush crypto, it'll crown it. Banks play a dangerous game, borrowing cheap deposits to hoover up treasuries with infinite leverage. But the party's ending. Trump's trade wars scare off foreign buyers, leaving banks holding the bag. If Japan's yen carry trade unwinds, it could trigger a treasury meltdown. The Fed's fix? Stealth money printing dressed up as bailouts. Meanwhile, gold and Bitcoin surge as smart money flees weaponized dollars. The system's a house of cards. When it falls, only hard assets will survive. Stack wisely. Let's watch more clips from the interview.
Very simply, a bank borrows at the short end from depositors and lends long. Now, banks don't like to take risk. As anyone who knows who had a risky, a business proposition or personal loan, they needed to go to the bank, and the bank said, I don't know about that. I guess we're to lend to S&P 500 or Fortune 500 companies because that's safer. So if I can borrow cheaply, if I'm a too big to fail bank, and I essentially have, my deposit rates are much lower than where the treasury market rates are, I borrow short, and I just go buy government debt. I don't have to put up any equity capital against this debt. Whereas if I had a personal loan or a car loan or a corporate debt, I have an equity charge. It costs me money to originate that loan. I have to put some of my own skin in the game. But it's a U.S. government says no more skin in the game. You can buy as much of the stuff as you want. Great. I have a positive net income margin as a bank. And I just ram that shit through infinite leverage. My stock price goes up, my earnings go up. Everybody's happy. So the banks want SLR because they're going to make a ton of money doing this. And the banks are going to get it because at the end of the day, if Trump is serious about this divorce of trade where the U.S. Treasury bond no longer is the global reserve asset, then who's going to buy this stuff? The banking system is the only person who can buy it, especially if the Fed is doing quantitative tightening or not doing QE to the level at which is necessary to mop up all of the supply of debt being issued. And it certainly isn't going to be the private sector because they spent all their COVID money on cars and washing machines. Everyone's fucking broke. I mean, the most obvious one, but not necessarily going to be the most likely, is carry trade unwind out of Japan. So obviously, Japan is a staunch ally of the US. They do whatever they're told. And if a weak dollar is necessary so that, the US can reindustrialize, Japan is the largest holder of treasury debt. It's not China, it's Japan. And the yen is weak. They keep it weak. The BOJ has been printing money for 30 years to solve their balance sheet recession that started in 1989. So at the end of the day, the world has financed itself with cheap yen. Yen went to 140 or below 140 yesterday. When the yen strengthens, people have to unwind these assets. They have to sell stuff. They have to sell bonds specifically. And so if we get a chaotic Japan unwind because Trump wants a weaker dollar, so the yen has to strengthen. Well, if the yen is strengthening and the BOJ is raising rates, then if I'm a Japanese person who's borrowed yen to buy stocks or bonds or whatever, I have to sell it and cover immediately because I'm about to lose money. Or if I'm a Japanese person, now I can buy a Japanese government bond and it yields enough so that I don't have to take that FX risk and go into treasuries. And so this is the unwind of Japan Inc.'s massive carry trade position as a country is probably the biggest risk to the biggest catalyst to the resumption of QE and explicit yield curve control. Because if Japan is going to repatriate the trillions of dollars of capital, most specifically in the United States, then they're going to have some accommodation from the Fed and the Treasury to make sure they don't blow up the U.S. financial system. The Fed can essentially print infinite amounts of money, hand it to the BOJ, and the BOJ can basically take these bonds off the private sector and warehouse them, and then the Fed will just continue to roll the loan. They've done it before during the 2008 financial crisis. They don't like to talk about it, but that's why all these things were created. And so I would imagine that's the simplest way for them to do it. And again, it's not considered quantitative easing per se, because it's not the technical definition of it, how the general layperson understands it. And so people would be oblivious to exactly why is the market going up? Why is my coffee, why is a coconut water $20 now? I thought they weren't printing money. No, they are printing money. It's just in a way that you don't understand. First off, Bitcoin has performed better than gold if you take a look just about any time frame.
True.
So
But
this is more of a relative thing. People see it going up and all that. And I own lots of gold. That's a great trade. At the end of the day, I think the big two events in the gold market of the last few years was February 2022, when the Biden administration decided to steal Russia's assets and freeze them. And destroy property rights. I mean, properties are already kind of destroyed, but to take the largest commodity producer in the world and say, okay, we're going to take your shit, that's a different sort of escalation. And then Trump rolled out these maximalist tariffs on everything except for gold and some commodities, which is tell in terms of where the system's going. So if you're a central bank manager or some sort of sovereign wealth individual and you've got all these dollars coming in, do you want to make the problem worse of owning these treasuries that you can't sell? The liquidity has declined. If you piss off the president, they sanction you and you no longer have access to your money. Do you want to keep buying that? Or do you want to buy gold, which has always been, for 10,000 years, sort of this neutral, stateless asset where people save energy for human civilization? Well, I want to buy more gold. And that's what they've been doing. Central banks around the world, especially in the global south and current account surplus countries, have been increasing their purchases of gold. Obviously, China's doing so. Other countries as well. Even like Poland in the EU, they have an explicit target. They want to bring it up to something like, 15 or 20% of their central bank reserves. So everybody understands that treasuries are no longer a risk-free asset. Yes, the U.S. government can print nominal dollars to pay you back. That's if they want to pay you back. If you're Russia, they don't want to pay you back. If there's a research piece by some Deutsche Bank strategists a few weeks ago stating that, could the Trump administration refuse to renew dollar swap lines and cripple the EU because they didn't do something he wanted them to do? Right? Again, that's just another part and parcel of a treasury bond is not risk-free. There is risk. You have to start asking yourself, what if? And when you start asking yourself, what if, then you might as well own gold, because there is no what if in gold. I own the gold in my vault. I've got a guy with a gun guarding it. I know that I've been able to buy oil and seeds and whatever for thousands of years with this shiny gold, this shiny metal. It's going to last longer than a U.S. treasury bond. I'm going to own some of this. That is the structural bid behind gold.
ARK invests staggering new Bitcoin price target of $2.4 million by 2030, a 60% jump from its previous high estimate, echoes the macro narrative Arthur Hayes has long championed. The forecast hinges on Bitcoin's shrinking active supply, institutional adoption, and its role as digital gold, themes Hayes has hammered home as central banks and governments weaponize fiat systems. With exchange reserves drying up, down 400,000 Bitcoin since late 2024, and giants like MicroStrategy hoarding coins, ARK's model reflects Hayes' thesis. When liquidity floods back into risk assets, Bitcoin will decouple and dominate. The drivers ARK cites, sovereign wealth funds, corporate treasuries, and emerging market adoption, mirror Hayes' warnings about treasuries losing their risk-free status and capital fleeing to hard assets. Even ARK's base case $1.2 million and bear case $500,000 outpaced traditional finance's wildest dreams, aligning with Hayes' view that Bitcoin's fixed supply will crush inflated fiat alternatives. Yet Hayes would likely caution, as ARK does, that volatility remains. Bitcoin's path won't be linear, but the structural bid is undeniable. From Michael Saylor's $13 million moonshot to Standard Chartered's $500,000 target, the smart money sees what Hayes has argued for years. The system is breaking, and Bitcoin is the fix. Whether it's $1 million by 2025 or $2.4 million by 2030, the race to escape fiat is on, and the finish line is a hard money standard. As we wrap up, do you think the US financial system really a house of cards? Or can it survive without hard assets like Bitcoin? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.